FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz, and today is 3/17/20. Well, we've seen tremendous volatility, turmoil, perhaps even a collapse in these markets. Where are we now? Where are we heading? Our good friend has deigned to join us. We appreciate it. Bob Hoye. Any questions or comments? Give us your feedback, where you think the market's heading. The email address is kl@kerrylutz.com. Bob, welcome. So what the heck is going on here?
Well, there's 2 aspects to it, Kerry. One is the virus, coronavirus, now described as a pandemic. And I'll deal with this one quickly because the Chinese communists in November, December kept this quiet because they wanted to conclude the trade deal with the U.S., and then they got that done. And then the next step, of course, the more authoritarian government, the more they can create a perfect society. And a major disease was most unwelcome, so they panicked and shut everything down, which was extraordinary. And it has rippled right through all of the financial markets, understandably. It's panicked people into a mania of buying things and stuff like that. But at any rate, and it's marked down the price of a lot of securities that were stocks and bonds that were way overpriced. So now we'll segue into the way we handled it. And early October, my colleague Ross Clark, and looking at the chart, said, hey, this thing can rally right out to the end of the year. And I said, well, this is great because we've often seen terrific highs at the late December, January window. And so we took that as a model and noted that the huge speculation in gold and silver blew out in January 1980. And then there was the fantastic Nikkei bubble in Tokyo, last trading day of 89. Then there was a very good bull market peak in January of 1973. And these were all followed by lengthy bear markets. So this is what we were on to. So then our work in December and January was looking for, back up one step. We did get the technicals we needed for a top. Our proprietary model gives upside exhaustions, which it's based upon 6 items and time and momentum. And then the other one is a model that we use, and it gives at top a sequential sell, which is based upon pattern. So we had momentum and we had pattern. So we got those in December, January. And about the middle of the month, I noted these and also noted that the valuations of the S&P relative to GDP and average wage were exceptional. So that the call was made is the market up when it should be? Yes. And then the next question was, are there signs of speculation? And I noted all of this. So then what we needed was a crack in the momentum, and that came in late January. So then the hit to stocks, low-grade bonds, and industrial commodities has been severe, particularly for crude oil. But this is what you get at the end of a huge speculative thrust. It's not just the stock market going down. It's all 3 items, low-grade bonds, stocks, and industrial commodities. And so you can never rearrange history, but I would suggest that we would have had a fairly dramatic sell-off anyways, based upon the excesses reached in in December and January. Now, there was one other one in here, Kerry, that I kind of like, and it was decades ago when I noticed that on the great financial bubbles going all the way back to the South Sea bubble in 1720, there was a huge speculation in commodities 9 years earlier, and that was 2011. So then you move ahead, like 1929, huge commodity peak in 1920, that 9 years. So the last commodity peak was in 2011. It wasn't huge, but it was cyclical. And we all know the drop in metal prices since that blow off in 2011. And you count it out. And although it's just the start of 2020, it counts out to 9 years. So then the other work was that oftentimes at the end of a decade, you can get a reversal of fortune. And 1989 was Tokyo, and 1980. So there was a lot of things saying that the market was poised for a decline, and we've got it. Some of our technical work on this, Ross called for a 38% retracement of the whole move from 2009 to 2020.
Wow.
And then a 30, in which we're getting, who knows, it may even do a 50%, or we've compared it to other breaks, like the crude oil from 147 in 08, Dow in 1929. So we've got a pretty good handle at keeping track of the decline. And with our two models that we use, will be very helpful in reentry. And I often say about our when you get an upside exhaustion, you then, the next part, it would be looking for a downside capitulation, and that we're not getting yet. But I've often quipped, Kerry, that with the downside capitulation model, it helps avoid trying to buy falling knives.
Mm-hmm.
So I would say each of the great bubbles in the past have had similar endings, and each of the contractions after have been similar, and this is on path. So we're looking at it in two ways. One is the internals on the markets themselves. Oh yeah, another one here was gets right out of the stock market, and that's the yield curve, which is the difference between long bonds and shorter dated credit instruments. And we use the 3-year Treasury bill right out to the 10-year, and it inverted in the summer. And then I've got the yield curve back to 1854, and there's one rule that jumps out at you, is if the curve inverts, it will be followed by a recession. That's for all these more than 100 years. Now, there was another thing, is that going into with the upthrust into the year end, the curve inverted again. So we look back, and in 2007 peak, the curve inverted twice. At the end of the 1929 bubble, part of that was the curve inverting twice. And then the previous bubble was 1873, and that was a terrific one, and it inverted twice. So you've got the credit market side. So it's all calling for a contraction that will overwhelm the policymakers and central bankers in an attempt to keep things inflated. But this actually comes out with a very good story for gold. And one of the things I did a long time ago was just take the price of gold in the senior currency, which used to be sterling, and then more lately US dollar, and deflate it by the consumer price inflation. And it tells a story. And in even back to the 1720 bubble, is that as the bubble concludes and is at its best, the real price of gold, adjusted for inflation, goes down. And the gold sector, underperforms. So then, and that's on each of them, right up to 1929. And then as part of the contraction, the real price of gold goes up. And the importance of that is it's Mother Nature at work, Kerry. Mm-hmm. You got a credit bubble on the normal instruments like bonds and notes and all that sort of stuff. Then on top of that, there's been the invented derivatives and all sorts of fancy CDCs and all this sort of stuff based upon credit. So it becomes overextended, and then the word contraction, credit expansion, contraction says it all. So of course, the sign of credit contracting is the loss of liquidity. Gone, yeah. Which we've seen in the last month.
Instantaneously, huh?
Instantaneous, that's the word. So then Mother Nature is actually looking after the thing because she puts the real price of gold up. So what that means is that your cost of mining, the price of gold will be such in a trend such that it's going up faster than the cost of mining, or the cost of mining are going down. Look at the cost, energy cost is represented by crude oil prices. So anyways, the real price goes up. The gold miners start to make some money, and the gold will go into the system no matter how the crazy central bankers dislike it. And so it begins to reflate the global financial system. But hey, this can take quite a while. So the typical post-bubble contraction has been about 20 years. It takes that long to wash out all of the crazy excesses in the credit markets. But you still have, the 4-year business cycle with things coming and going. You'll have weak recoveries and strong recessions. And this then, with the real price of gold going up, I'll give you the example. In the 1929 bull market, Homestake was the premier gold producer, and they were at a pretty constant rate of production, maybe, a little over 200,000 ounces a year. And of course, in the 1928-29 boom, their costs went up and their earnings reports went down. And so while the gold stocks did go up with the 29 boom, they were the underperformers. So then Homestake sold off into the low 8s with the crash. And then in 1930, part of 31, you could buy Homestake at around $9 a share. And then it started to work. So if you take a look at when Roosevelt came in, he didn't raise the price of gold until March 1933. But the real price had gone up, so that if you take a look at Homestake's reports for the end of 1932, their earnings had gone up. Mm. The price of gold before the crash was $20.67 an ounce. The price until 1933 was $20.67 an ounce, so the price hadn't changed. But the cost of mining had plunged, so their earnings were up, and I'm just remembering, Kerry, maybe around 130% on 1932, and the stock was up in the order of that when the Dow Jones was crashing. There were times, of course, when in the crash, when the gold stocks got hit. So what I'm building it carries a case that while these whipsaws are ugly and disquieting, we're on the path to a lengthy contraction, and with that, one of the most fabulous bull markets for gold you can imagine. And it doesn't matter what the price does in U.S. dollars, so long as the real price is going up, and it is, because the latest posting for the January month on the CPI put the real price of gold to a new high, higher than reached in September. And then there was the correction in the real price, and now it's at a new high. And this is one of the features of a post-bubble contraction, is the real price of gold going up. So it, of course, whipsaw lately, because the transition to this contraction has been violent. They all have been.
Yeah.
But I'm sure that on our technical work that we will be able to be fairly comfortable in identifying the next entry point on the gold stocks. Now, there's also something else with the precious metals, and that's silver. And in a boom when both silver and gold are going up, of course, silver will always outperform gold, and it does. But the trick is that when you're in a post-bubble contraction, silver underperforms gold. And it was somewhere about 6 months ago, I reviewed that and pointed out that on this next contraction, when it came in, that could move the gold-silver ratio up. And I just picked a number out of the air, maybe 115. And I think we're at that now. So silver is doing what it should be doing. And when you look at it, the gold-silver ratio is kind of a metallic credit spread. And it goes down in a boom, which we'd had, and
right.
It goes up in a contraction, which we're getting. And I don't know, that 115 on the gold-silver ratio, I just pulled that out of thin air, I mean, you just had to...
Isn't that shocking? Isn't that a shocking number?
But we're there. And the last time it got to above 100 was when commodities had... And inflation was the horror show right up to about 1980. And then the whole oil patch came apart, and you had deflation in base metals and all that sort of stuff. And then that long contraction. So in the end of 1990, I think it was then the huge banks, the big, huge money center banks, New York, or the Citicorp and Chase Manhattan were broke, insolvent.
Right.
And Greenspan then had to move to rescue them, and then lowered reserve requirements. And with that disaster, the gold-silver ratio, I think, got to 104 or 105, briefly. So the gold-silver ratio is doing what it typically does in a post-bubble contraction. It declines relative to gold, because gold underneath it all is money. And as I said, with the real price going up, the producers, the gold miners, will become more profitable and start mining more of it. And it doesn't end there, because you have the exploration companies, and they've got prospects and properties they're exploring, properties they're developing. And while not in production, the same thing, there is a valuation shift there where, with the real price going up, it makes the valuation of a prospect that much higher. So I'm very bullish on everything in the gold sector, from the majors right down to exploration stocks. And it's going to be a lot of fun once we get through these immediate liquidity problems.
Right, which will probably be addressed shortly. They can try to rebuild, they can try to do these tricks, printing up money, etc. One thing, though.
Yeah, but the New York Fed is always the biggest one. And in 1929, and this story is basically buried, but you can read about it in libertarian publications. A guy by the name of Harrison was head of the New York Fed, and in the immediate crash, like October, November, he bought bonds out of the market, and he had an authority. He was limited to so much of intervention, and the source I read, he extended his authority by a factor of 6 times. So he bought bonds out of the market huge, and you still had the crash.
Yeah.
The 1932 Barron's, July 1932, which was at the bottom, and in an editorial they write that every anti-deflationary measure taken by the Federal Reserve is seen not to be working. Now, that was a despairing comment right at the bottom of that first bear market. But it points out that the Fed was actually easy, and of course, naturally, short rates came down. Treasury bill rate went to almost zero. So this massive effort by central bankers around the world to reflate, it's been tried before. Even in 1873, that's when Walter Bagehot, the very highly esteemed editor at The Economist magazine, he published a book called Lombard Street, which was about the money market in London. And in it, he identified that major setbacks are not good and that they could be prevented by the central bank hugely easing. Now, the irony on that one is he published it in 1873.
Yeah, before Milton
was the
Friedman.
Height of a bubble, and it went into a 20-year Great Depression. And then in New York at the same time, in the summer of 1873, the New York Herald newspaper editorialized that the U.S. did not have a central bank constrained by gold. It had the national banking system where the Secretary of Treasury had all the power, and he could inject any amount of liquidity into the market. So England says that a central bank on gold would save the day. New York says that a mere central bank on gold wouldn't work, but they had fiat currency and the treasury system, and that would work. Of course, it didn't. In 1884, the recession and weakness in England, which was the senior economy, was such that leading economists in England started calling that contraction the Great Depression. And ironically, as late as 1939, senior economists in England were writing papers on how it could have been prevented or how it could have been less deadly, that sort of thing. And then in 1930, they've got another depression to look at. But until 1939, if you had mentioned in economic circles the Great Depression, it only meant the 1873 to 1895 contraction. So there's wonderful ironies out there, Kerry.
Yeah. So one thing that we didn't have back in the good old days in the 20s and during the Great Depression were these gold royalty companies who've kind of stepped in to provide financing to develop mines in exchange for a piece of the action effectively. Those royalty companies really stand to go up a lot because they get all the benefits of higher gold prices with none of the burdens effectively.
FSN Radio. It's all about what's next.
Arcana Corporation is on the verge of bringing the world's highest grade silver mine into production. The Revenue Virginius mine in Colorado has proven improbable silver reserves grading nearly 37 ounces per ton silver with an all-in sustaining production cost of only US $8 per ounce of silver. The mine is fully permitted with infrastructure already in place, and the company has announced they plan to commence production in 2020. Achieving successful production usually results in a significant upward share price re-rating on the Lassonde curve. Arcana trades under the ticker AUN in Toronto and AUNFF in New York. To learn more, go to arcana.com. That's AURCANA.com.
The Financial Survival Network. It's all about what's next.
Oh, that's genius, Kerry, that stuff. Now, let's make another comparison here, going back to 1929 and that bust, is Homestake stock then went to the 65 level through 1935-36, and from a 9 base where you could have bought it for a year at 9. And here's the other thing. In those days, the gold miners paid everything out, dividended everything out.
Yeah.
So here in 1935, you bought your stock in, say, 1931 at $9, and in the mid-30s, it was paying $4.50 a share dividend. So the play then was that a single mine company paid everything out in dividend and really didn't become ambitious. Whereas nowadays, the corporate world is that guys with a gold mining company are going to grow the business, and you grow the business by employing the money rather than paying it out all in dividends. But it'll be a terrific bull market when it gets going.
How long do you think it's going to take to get going? Because we saw a lot of people
here
panic.
we are, right in a crash.
Yeah.
And you want me to be a genius.
Yeah, well, I think...
on the stock market, you can't re-enter until you've had a tested low in, and that will hold for industrial commodities. It'll hold for gold and silver there. So it goes back to the discipline of technical research and your tools to use to identify a low and then execute the decision to take a position or to begin to take a position. And I'm confident when we get there, we'll be able to state it. And this is what we did in 1st of November 17 when it had crashed hard into September, and then we wanted to see a more of a low in the stock market. No, not 17. Yeah, that's right. So we held off, and it was the 1st of November when we put the buy on because it looked like most of the pressures in the stock market had come in. And so that was the buy, and it was quite timely. The GDX was double tested the low in September. And then we had the very good rally until last summer when things became overbought. And I noted the overbought and said that one could take a little money off the table just as a cautionary measure. And also at the time said that we would be confident on the next entry or the next point when you would add to positions, and without then last summer thinking that it would be quite this evil. So it's setting up the next move should be quite outstanding, and because it'll take the gold community some time to figure out that it's your cost that you're going to be interested in. Mm-hmm. And with the gold, look at how far crude oil has come down from 66 last September down to a 26, 27 level, and that represents energy costs. So right. It's already working. So eventually the gold community will figure out that what really counts is not so much the price soaring to 10,000, but it is in real terms, the real earnings going up that could lead to a move that's equivalent to 5,000 or 10,000. I just put those numbers out because they're crazy numbers. But the main thing you want to know is that we will be in a proper bull market for gold stocks based upon advancing earnings. So I'm looking forward to it.
And when you look at a lot of these remote projects, often either the first or second largest cost is energy to dig the rocks out, dig the gold out, energy to smash it up, and energy to transport mm-hmm. the resulting concentrate to wherever you're going to send it. So it makes a lot of projects more viable than would be otherwise.
Remember going into the top of the market in 2011, going into there was all the concerns that there was no shortage of big tires for the big earth-moving equipment and shortage of this, and wages were soaring. Now, as part of the post-bubble contraction, industrial commodities go down, particularly base metals. And what happens to base metal mining when prices get too low? They shut down. What happens then? There's equipment available. There's miners available. So then this extends the downside pressures on operating costs. It's because you're going to have miners available that otherwise would have been working in mining copper or other base metals, and the same thing with all the equipment and tires and everything else. So this is where it becomes sort of a wonderful thing, where while the base metal mining is tanked, that then makes it all the more profitable for gold mining. And that goes all the way back. Like I said, I deflated gold price beginning in 1700, and this did it annually, and then it jumps out at you that the real price of gold has gone down seriously with each of the great bubbles, and then it goes up seriously afterwards. So,
and one other thing, when those base metal mines shut down, a lot of their byproducts they don't even care about is silver and gold, because it's a minor amount of their total revenue, and it's just gravy basically. But then when they shut down, you lose a big source of that byproduct mining, and
you
therefore
miss that supply. Yeah.
So
that's a good
supply
point.
shrinks.
Yeah.
Supply shrinks. Well, we got interesting times ahead, and we're going to see a big move. My guess is, based on all the cycles that I've looked at, sometime probably in the summer. But it looks like as of today, as we speak, the metal stocks are getting a bounce, even though the price of gold and silver are down. We're down on the 16th.
It's going to re-entry is always difficult, but the worse the disaster, better the opportunity. So, but don't try and catch a falling knife.
Yeah,
they don't have handles.
Yeah, don't try to outsmart the market. The market is going to beat you every time. The market is always right. It can be manipulated in the short term, but in the long term, it ain't going to work. Even by the likes of the Federal Reserve, it's not going to work. Hey, just as a note here, there's actually a coronavirus trial taking place in the United States now by the National Institute of Health. So when the president spoke and said we were close to a vaccine, he wasn't lying. 45 young healthy volunteers going to receive different doses. They know the thing works already, but you can't just release it until you have adjudged all the side effects and the proper dosages and all of that good stuff. So,
also, Kerry, I read one just this morning. Australian medical research have got some kind of a HIV remedy that looks like it's working with this coronavirus. So
I heard that.
Leave the free market alone, and it will come up. Now, whereas in the U.S., you got the FDA saying, to the pharmacy company, you can't do that. It has to be tested longer, all that sort of bureaucratic stuff. And Trump is finding a way to get around the apparatus of government,
the FDA,
people.
The FDA, but you do have to properly test. I mean, you're going to put this out into millions of people. We've seen the absolute disasters that have occurred when the testing wasn't proper and when they missed things. Yeah. So we don't want that. Well, anyway, hey. Just tell us, Bob, best place to find you. We just Google Bob Hoye, I'm sorry. We just basically Google your name, Bob Hoye, and it's HOYE. BOBHOYE.com. And then you can get into a couple of websites where we review what we do and review the record. And hellish times, but that's as it gives us opportunities. Yeah, well, hellish times, but sometimes you got to go through hell to get to heaven. I think there was a rock song about that.
I like that one, Kerry.
If you want to get to heaven, you got to go through hell, I think was the name of the song, and that's what we're going through now. Really appreciate you coming on. Any questions or comments for Bob, myself, KL@KerryLutz.com. That's the email address. Twitter feed @Kerry Lutz. Facebook page is Financial Survival Network. And of course, the home site, financialsurvivalnetwork.com. Bob, it's always great having you on. Can't thank you enough for taking time out and helping to clarify what's going on. And we'll just sit back and wait for the magic moment.
Indeed, Kerry. Thanks. And we look forward to talking to you soon.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.